Hello and welcome back to The Note, coming to you again this week from our new offices in New York. Well, today was the day that many of us heard from Janet Yellen for the first time. She's of course the prospective next chair of the Federal Reserve. She's been talking to Congress, and many people think that she's been very much more dovish than they had anticipated. That in turn has led to even more speculation that the Fed could be cooking what you would call a stock market melt up. That with so much stimulus coming from the Fed, stocks are just going to boil over. That's the topic I'd like to discuss today with my guest, who is our US markets editor, Mike Mackenzie. Mike, thanks for coming on The Note today. Let's start by taking a look at what's happened in the 24 hours from midday on Wednesday through to midday on Thursday, the time when we heard Janet's testimony for the first time and then saw her speak. What do you think is the story of the market reaction to Janet's coming out?
Pleasantly surprised. I think Yellen sort of said keep calm and carry on. So that's what we're seeing. We're seeing equities continue to rise. We've hit a new record high today. The market's now up more than 25% year to date. And there's a feeling that a lot of investors who perhaps haven't been fully invested in the stock market this year now need to catch up. And it's this kind of classic performance chasing you get towards the end of a year, particularly when assets have done very well, which is where we get the buzzword melt up is coming from. So I think Janet has successfully opened the door to a further rally into the end of the year.
Now, are you surprised by the tone she took in terms of just the pure game theory of the situation? It would have seemed to make sense for her to talk more hawkishly, give herself a little bit more room for manoeuvre. Did it personally surprise you that she
No,
came
and I
over?
think the reason for this is that perhaps if inflation was rising, she'd have to would have had to have adopted a more hawkish tone, just to sort of keep the bond vigilantes on watch. That look, we're going to make sure inflation doesn't run away from us. The problem the Fed's got, and it's also one that's shared by the ECB, is that inflation is actually falling here at the moment, and that's the part that's. I mean, the Fed has a dual mandate, and obviously they're very focused on the unemployment rate. And again, Dr. Yellen spoke at length about that. It needs to come down. They're worried that a lot of people are no longer employed in the market, and it's holding back the economy's recovery. But the other aspect, of course, and the reason why we have QE and all these enormous efforts the Fed's done since 2008 is because they've been worried about disinflation.
Right.
And we're on the cusp of seeing that again. And I think that's why she stuck to this very balanced view, because when the core rate of inflation is currently running at 1.2%, the Fed's got a target of 2%, and we know the Fed wouldn't mind seeing it get up to 2.5%. So we're well away from any kind of danger sign on inflation.
Now, okay, let's take a look at this in longer term perspective. Well, this is a chart that we've shown once or twice before, showing this quite remarkable relationship between the expansion in the Fed's balance sheet and stock prices. Do you think this is a coincidence, or is the correlation as strong as it appears? And if so, you seem to be suggesting that we have QE for a long time into the future. Does that imply that we really will melt up to a point where stocks are infeasibly overvalued?
Well, yes, I think it's unquestionable that if you look at the amount of the way the Fed's balance sheet is now approaching 4 trillion, and you map that against stock prices as you see on that chart, there's an undeniable link. And a lot of investors have, and again, the Fed itself has said, we're doing QE because we don't want you to be owning treasuries. We want you to go out and take on more risk, buy stocks, buy corporate bonds, high yield bonds, and hoping that the wealth effect will benefit the economy. We've yet to see that. And that's one of the problems we're having with QE. It simply hasn't worked. We've gone through at least 3 iterations of this. And yes, stocks have rebounded and they're shooting higher, but we're not getting the broad economy. In a way, QE is great for financial assets. It's not really working that well for the broad economy.
Okay, now one final question, which is always, or has been unavoidable for many months now. When do you think the market thinks tapering is going to start? Do you think the market's right?
I think the market's looking towards next spring, and I think it's a pretty clever move, because you've got Ben Bernanke's final meeting in January. I don't think they'll do it in December, purely because it's year end. Right. Things get quite sketchy in terms of liquidity anyway. And then Janet Yellen becomes the new Fed chair early next year. We then have yet another possible showdown in Washington over the fiscal situation, which is one of the reasons why they didn't taper in September. So it sort of clears the decks for March, April, I think, for a possible reduction in QE. And I think the big question now is, can they do a reduction in QE and then try and keep the bond market contained in terms of rising long-term yields by sort of coming up with a new plan, say along the lines of saying, well, we're going to keep rates at 0 until 2017, or we're actually going to lower the unemployment threshold from current 7% down to around 5.5%.
Okay, Mike, thank you very much indeed. I think if there is a lesson to be drawn from that, it's one of those cliches which, unfortunately, even though it's a cliche, is true. Don't fight the Fed. It looks as though we are in for QE for somewhat longer even than most had expected, and while that's the case, it's dangerous to get out of equities.